Every great investor in the world, whether managing billions of dollars or just starting out with a very first investment, shares one powerful and common trait. They understand numbers, not just any numbers, but the specific numbers that tell the real truth about a business. That truth, the unfiltered, undeniable truth about whether a company is healthy or sick, whether it is growing or quietly dying, whether the people running it are honest or quietly deceptive, lives inside financial statements. This is where the real game of investing is played. This is where great fortunes are made. And this is where people who do not know what they are looking at lose everything. Today, you are going to learn how to play this game at the highest possible level, and you are going to come out the other side with a set of skills that the majority of investors in this world simply do not have. Martin S. Fridson is one of the most respected names in the world of financial analysis. He has spent decades studying, teaching, and applying the deep science of examining corporate financial statements. What he has built is not just a collection of formulas or accounting tricks. What he has built is a complete system for understanding the financial reality behind any business. Whether you are analyzing a technology giant, a retail chain, a manufacturing company, or a small startup trying to go public, the tools and principles Fridson teaches will give you an extraordinary and lasting edge. And here is why this matters so deeply to you as an investor. Every single day, millions of dollars change hands based on decisions made by people who have looked at financial statements. Some of those people understand what they are seeing. Most do not. The ones who do understand are the ones who consistently make better decisions, avoid costly mistakes, and build lasting wealth over time. The ones who do not understand are left guessing, hoping, and eventually, in most cases, losing. The knowledge you are about to gain puts you firmly in the first group. So let us begin. Let us start from the very foundation and build upward, layer by layer, until you have a complete, clear, and powerful understanding of how to analyze any company's financial statements with the kind of confidence and precision that professional analysts spend years developing. The world of financial statements is built on three core documents. Every publicly traded company in the world, and most private companies of significant size, is required to produce these three documents on a regular basis. Together, they paint a complete picture of a company's financial health. Separately, each one tells a different part of the story. The first is the income statement. The second is the balance sheet. The third is the cash flow statement. Understanding each one individually is important, but understanding how they connect to each other, how a number in one statement flows into another, how they confirm or contradict each other, that is where the real insight lives. And that interplay between the three statements is what separates truly skilled analysts from people who only look at one number and think they know the story. Before diving into each statement in detail, it is important to understand something fundamental about financial statements in general. They are prepared by human beings using judgment under a set of rules called accounting standards. In the United States, those standards are called Generally Accepted Accounting Principles, or GAAP. In most of the rest of the world, the standards are called International Financial Reporting Standards, or IFRS. These standards provide a framework, but they also provide room for choices. Companies can choose between different ways of calculating certain numbers. They can make estimates about things that have not yet happened. And in some cases, they can use perfectly legal techniques that make their financials look better than the underlying reality. Fridson teaches you to see through all of that. And that is one of the most valuable skills any investor can ever develop. Let us begin with the income statement, because it is usually the first place investors look, and also one of the most frequently misunderstood. The income statement is sometimes called the profit and loss statement, or simply the P&L. Its job is to show you how much money a company brought in over a specific period of time, usually a quarter or a year. and how much of that money turned into profit after all expenses were paid. At the very top of the income statement, you will find revenue. Revenue is the total amount of money the company earned from selling its products or services. This is sometimes called the top line because it literally sits at the top of the statement. Revenue is a critical number, but by itself, it tells you very little. A company can have enormous revenue and still be losing money. What matters is what happens to that revenue as you move down the statement, step by step, deduction by deduction, until you arrive at the final profit number. After revenue, the next major line item you will encounter is the cost of goods sold, which is sometimes abbreviated as COGS. The cost of goods sold represents the direct costs that the company incurred in order to produce the products or services that it sold. For a manufacturing company, this includes the cost of raw materials, the wages of workers on the production floor, and the cost of running the machines. For a retailer, this is primarily the cost of buying the products from suppliers. For a service company, this might be the cost of the labor directly involved in delivering the service. The nature of these costs varies enormously across industries, but the concept is the same everywhere. These are the costs you simply cannot avoid if you are going to produce and deliver what you sell. When you take revenue and subtract the cost of goods sold from it, you get a number called gross profit. Gross profit is the first measure of profitability on the income statement, and it is an important one. It tells you how much money the company has left after covering its direct production costs, before accounting for overhead expenses like salaries for management, rent, marketing, and so on. The relationship between gross profit and revenue is expressed as the gross margin, and it is calculated by dividing gross profit by revenue and then multiplying by 100 to express it as a percentage. A high gross margin means the company is able to sell its products or services at a significant premium over what it costs to produce them, which is a sign of pricing power, brand strength, or operational efficiency. A low gross margin means the opposite, and it can signal that the company is in a brutally competitive market where no one has real pricing power. Now, let us talk about operating expenses. After gross profit, the income statement shows you the operating expenses of the business. These are the costs of running the company beyond the direct costs of production. They typically include selling, general, and administrative expenses, which are often grouped together and called SG&A. They also include research and development expenses, which are particularly important for technology and pharmaceutical companies. They include depreciation and amortization, which are non-cash charges that represent the gradual wearing out of physical assets and the gradual expense of intangible assets, like patents and customer relationships. When you take gross profit and subtract all of these operating expenses from it, you arrive at operating income, which is also sometimes called earnings before interest and taxes, or EBIT. Operating income is one of the most important numbers on the income statement, and here is why. It measures how much profit the company generates from its core business operations before accounting for interest payments on debt and before accounting for taxes. This makes it a useful number for comparing companies across different industries and different countries because it removes the effects of how a company is financed and where it pays its taxes. Two companies with the same operating income but different amounts of debt will look very different at the bottom of the income statement, even if their underlying businesses are equally strong. Operating income lets you cut through the noise of financing decisions and tax strategies and focus on the raw operational performance of the business itself. Speaking of interest, the next section of the income statement deals with interest income and interest expense. If a company has cash sitting in a bank account or invested in securities, it may earn interest on that cash, which would appear as interest income. If a company has borrowed money through bonds or bank loans, it pays interest on that debt, which appears as interest expense. The net effect of these two items is added to or taken away from operating income to give you earnings before taxes, which is sometimes called EBT. Then come the taxes. Corporate income taxes are deducted from earnings before taxes to give you the final bottom line number, which is called net income, or sometimes net profit, or simply the bottom line. Net income represents the total profit the company made for its shareholders after all costs, expenses, interest, and taxes have been accounted for. But here is something critically important that Fridson emphasizes throughout his work. Net income, the bottom line number, is often the most manipulated number on the entire income statement. Companies have many ways, all perfectly legal under accounting rules, to make net income look higher or lower than it might otherwise be. And smart investors learn to look beyond net income to understand what is really going on beneath the surface of the reported figures. One of the most important tools for doing this is the concept of earnings quality. Earnings quality refers to how closely a company's reported earnings reflect its true economic performance. High-quality earnings are sustainable, repeatable, and backed by actual cash. Low-quality earnings are often the result of one-time items, accounting choices that pull future earnings into the present, or aggressive revenue recognition practices that inflate the top line without a corresponding improvement in the underlying business. Let us talk about some specific ways that earnings quality can be compromised. One common technique is called channel stuffing. This happens when a company pressures its distributors or retailers to buy more inventory than they actually need at the end of a reporting period. This inflates revenue in the current period, but it creates problems in the future when those distributors have too much inventory and buy less from the company in subsequent periods. Another technique involves changing the timing of when expenses are recognized. If a company can push an expense into the next period, it reduces costs in the current period and makes profits look higher than they truly are. Another common approach is to take advantage of one-time gains, such as selling a building or an investment, and including those gains in operating income to make the core business look more profitable than it actually is. The way to detect these kinds of manipulations is to go beyond the headline numbers and look carefully at the details. This is where footnotes become incredibly important. Fridson places enormous emphasis on the footnotes to financial statements. Most investors ignore the footnotes. Most investors also make avoidable and expensive mistakes. This is not a coincidence. The footnotes are where companies are required by law to disclose all the important details and assumptions behind their numbers. Changes in accounting methods, significant estimates, contingent liabilities, details about pension obligations, related party transactions, and dozens of other critical pieces of information are found in the footnotes. If you are evaluating a company and you are not going through the footnotes, you are making a decision with incomplete information, and incomplete information leads to incomplete decisions and incomplete returns. Now let us move to the second of the three core financial statements, which is the balance sheet. The balance sheet is a snapshot of a company's financial position at a single point in time. While the income statement covers a period, such as the full year from January through December, the balance sheet captures one specific moment, typically the last day of the reporting period. It shows what the company owns, what it owes, and what is left over for the shareholders. Think of it as a photograph taken at midnight on the last day of the year. The income statement is the movie that played all year long. The balance sheet is the single photograph taken when the movie ended. The balance sheet is organized around a fundamental equation that drives all of accounting. Total assets are equal to total liabilities plus shareholders' equity. In simple words, everything the company owns, the assets, must be funded by something. Either it is funded by money the company borrowed, which are the liabilities, or it is funded by money that the shareholders put in, or that the company has earned and kept over time, which is the shareholders' equity. This equation must always balance. If it does not, there is an error somewhere in the accounting records. Let us look at the assets side first. Assets are organized on the balance sheet from most liquid to least liquid. Liquidity refers to how quickly and easily an asset can be converted into cash. At the very top of the assets section, you will find current assets. Current assets are expected to be converted into cash or used up within 1 year. The most important current assets are cash and cash equivalents, which are simply the money the company has on hand or in short-term investments. Next, you typically find accounts receivable, which is money that customers owe to the company for goods or services they have already received but not yet paid for. Then there is inventory, which represents the goods the company has produced or purchased and is holding for sale. These three, cash, receivables, and inventory, are the core building blocks of working capital, and as you will see, they play an enormous role in understanding a company's operational health. Below the current assets, you will find long-term assets, sometimes called non-current assets. The most important of these for most companies is property, plant, and equipment, which is often abbreviated as PP&E. This includes factories, warehouses, vehicles, machinery, computers, office furniture, and anything else that the company owns and uses in its operations for more than 1 year. These assets are listed on the balance sheet at their original cost, minus accumulated depreciation. Accumulated depreciation is the total amount of depreciation that has been charged against the asset since it was purchased, reflecting the gradual wearing out of the asset over time. The resulting number is called the net book value of the asset, which is its original cost minus everything that has been depreciated away. Another major category of long-term assets is intangible assets. These are assets that do not have a physical form but still have value. They include things like patents, trademarks, customer relationships, and software. A very specific type of intangible asset that appears frequently on balance sheets is goodwill. Goodwill arises when a company acquires another company for a price higher than the fair market value of its net assets. The difference between what was paid and what the acquired company's net assets were worth is recorded as goodwill on the acquirer's balance sheet. Goodwill can be a significant number on many balance sheets, and Fridson teaches you to look at it carefully and critically. A large and growing goodwill balance can sometimes be a sign that a company is overpaying for acquisitions, making deals driven by ambition or pressure rather than sound economic judgment. Now let us look at the liabilities side of the balance sheet. Just as assets are divided into current and long-term, liabilities are also divided the same way. Current liabilities are debts or obligations that must be paid within 1 year. The most common current liabilities include accounts payable, which is money that the company owes to its suppliers for goods and services it has received but not yet paid for. Current liabilities also include short-term debt and the current portion of long-term debt, which is the amount of long-term loans that must be repaid in the coming year. They also include accrued expenses, which are expenses that have been incurred but not yet paid, such as wages owed to employees for work they have done, but for which payday has not yet arrived. Long-term liabilities include things like long-term debt, which are bonds or bank loans that do not need to be repaid within the next year. They also include deferred tax liabilities, which arise from timing differences between when taxes are owed according to accounting rules and when they are actually paid to the government. They also include pension obligations, which represent the company's commitment to pay future retirement benefits to its employees. Pension obligations deserve special attention from investors because they can be extremely large and because the calculations behind them involve many assumptions about things like how long employees will live and what investment returns the pension fund will earn. Small changes in these assumptions can result in large changes in the pension obligation on the balance sheet, and therefore large changes in the true financial strength of the company. After taking all liabilities away from all assets, you arrive at shareholders' equity, which is also called stockholders' equity or net worth or book value. This represents the residual interest that the shareholders have in the company after all its debts are paid. Shareholders' equity is made up of several components. The most important are common stock and additional paid-in capital, which together represent the money that shareholders originally invested in the company. Then, there is retained earnings, which represents the cumulative profits that the company has earned over its entire life, minus any dividends that have been paid out to shareholders. Retained earnings that are growing steadily over time are generally a positive sign, suggesting that the company is consistently profitable and choosing to reinvest in its future rather than distribute all its profits. Now, Fridson teaches an important principle about the balance sheet that surprises many new investors. Book value, which is the shareholders' equity number on the balance sheet, is rarely an accurate reflection of the true economic value of a company. And here is why. Many of the most valuable assets of modern businesses are not captured on the balance sheet at all. A company's brand reputation, its customer relationships, its employee talent, its proprietary processes, its network effects. These are all enormously valuable in the real world, but they generally do not appear on the balance sheet at anything close to their true value, because accounting rules require assets to be recorded at historical cost, and many internally developed intangibles cannot be recognized at all under the rules. This is why successful companies often trade at prices far above their book value in the stock market. Investors are paying not just for the book value of the assets, but for the future earning power of the business, which the accounting records cannot fully capture. Conversely, if a company is trading below its book value, investors are essentially saying that the business is worth less as a going concern than the sum of its parts would be if the company were liquidated and all the assets were sold off separately. This can sometimes signal a deeply undervalued opportunity, but it can also signal that the book value is overstated, meaning that the assets on the balance sheet are not actually worth what the accounting says they are worth. Fridson teaches you to distinguish between these two very different situations, and the skill of making that distinction can be enormously valuable. Now, let us move to the third core financial statement, which many experienced investors consider the most important of all. That is the cash flow statement. The cash flow statement shows how cash moved in and out of a company during a specific period. It begins with net income from the income statement and then makes a series of adjustments to show you the actual cash that was generated by the business. The reason this is so powerful is that companies can report profits on the income statement while simultaneously running out of cash. And as the old saying goes in financial circles, profit is an opinion, but cash is a fact. The income statement is built on accounting rules and estimates and judgments. The cash flow statement gets closer to the undeniable physical reality of money coming in and money going out. The cash flow statement is divided into 3 sections. The first section is called cash flows from operating activities. This section starts with net income and then adds back non-cash charges like depreciation and amortization, because while these expenses reduce net income, they do not actually require the company to spend cash. The company is not writing a check to anyone when it records a depreciation charge. The cash was already spent when the asset was originally purchased. Depreciation is simply spreading that cost over time in the accounting records. When you add it back to net income in the cash flow statement, you are removing the accounting fiction and getting closer to the actual cash reality. The cash flow from operations section then adjusts for changes in working capital, which are the changes in current assets and current liabilities. For example, if accounts receivable increase during the period, that means the company recorded sales on the income statement but has not yet collected the cash from customers. This would reduce operating cash flow relative to net income because the profit was booked, but the money has not yet arrived. If accounts payable increased, that means the company has received goods from suppliers but has not yet paid them. This would increase operating cash flow relative to net income because the company is temporarily using the supplier's money and conserving its own cash. The number that results from all these adjustments is called cash from operations, or operating cash flow. This is one of the most important numbers in all of financial analysis. A company that consistently generates strong operating cash flow is a company that is genuinely profitable in a real, tangible, cash-based sense. A company that consistently reports net income but generates weak or negative operating cash flow is a company that is worth examining very carefully, because something in the relationship between its accounting profits and its actual cash generation does not add up. And when something does not add up, there is almost always a reason, and that reason is almost never a good one. The second section of the cash flow statement is called cash flows from investing activities. This section shows the cash that the company spent on long-term investments and the cash it received from selling long-term assets. The most important item here is usually capital expenditures, which is the money the company spent on property, plant, and equipment. Capital expenditures are sometimes called CapEx. This is the money companies spend to maintain, expand, and upgrade their physical operations. CapEx is important for two reasons. First, it tells you how much the company is investing in its future growth and capacity. Second, it allows you to calculate a very important metric called free cash flow, which is operating cash flow minus capital expenditures. Free cash flow is the cash that the company generates after paying to maintain and grow its asset base, and it is the cash that is truly available to be returned to shareholders through dividends and buybacks, or to be used to pay down debt or make acquisitions. Free cash flow is the lifeblood of long-term shareholder value creation. The third section of the cash flow statement is called cash flows from financing activities. This section shows the cash that moved between the company and its creditors and shareholders. Cash inflows from financing activities come from borrowing money through loans, or issuing new bonds, or from issuing new shares of stock. Cash outflows from financing activities come from repaying debt, paying dividends to shareholders, or buying back shares. This section tells you whether the company is leaning on external financing to sustain itself, or whether it is generating so much cash from operations that it can afford to return capital to its owners. Looking at all three sections together gives you a complete picture of how a company is generating and using cash. A healthy, mature company typically generates most of its cash from operations, spends some on capital expenditures to maintain and grow the business, and returns the remainder to shareholders through dividends and buybacks. A growing company might generate strong operating cash flow, but spend even more on investing activities as it expands aggressively. A company in financial trouble might be generating negative operating cash flow and covering the gap by borrowing more money, which would show up as a cash inflow from financing activities. Seeing this pattern in the cash flow statement is one of the earliest warning signs that a company is in distress, often appearing long before the trouble becomes front-page news. Now, let us move into the world of financial ratios, because this is where the analysis really starts to come alive. Financial ratios allow you to take the raw numbers from the financial statements and transform them into meaningful metrics that can be compared across time periods, across competitors, and across industries. Fridson organizes financial ratios into several categories, each measuring a different aspect of a company's financial health, and together they build a comprehensive portrait of the business. The first category is liquidity ratios. Liquidity ratios measure a company's ability to meet its short-term obligations, meaning its ability to pay its bills as they come due without resorting to emergency measures. The most commonly used liquidity ratio is the current ratio, which is calculated by dividing current assets by current liabilities. A current ratio greater than 1 means the company has more short-term assets than short-term liabilities, suggesting it has enough liquidity to meet its near-term obligations with room to spare. A current ratio below 1 is a potential warning sign. However, context matters enormously. Some industries naturally operate with low current ratios because they collect cash from customers before they have to pay their suppliers. Retailers, for example, often collect cash immediately from customers, but pay suppliers weeks or months later. So a low current ratio for a retailer might not be cause for concern. A more conservative measure of liquidity is the quick ratio, which is also sometimes called the acid test ratio. The quick ratio is calculated by taking current assets, removing inventory from the total, and then dividing by current liabilities. The reason inventory is removed is that inventory is often the least liquid of the current assets. In a crisis, a company might not be able to sell its inventory quickly at full price, or might not be able to sell it at all, depending on the nature of the goods. By removing inventory from the calculation, the quick ratio gives you a more conservative and often more realistic picture of a company's immediate liquidity position under stress. The second major category of ratios is profitability ratios. These measure how effectively the company is converting its revenues, assets, and equity into profits. We have already discussed gross margin, which is gross profit divided by revenue. There are several other important profitability ratios worth understanding. Operating margin is operating income divided by revenue, and it tells you what portion of each dollar of revenue the company keeps after covering all its operating costs. Net margin is net income divided by revenue, and it tells you what portion of each dollar of revenue ultimately becomes profit for the shareholders. Together, these margin ratios tell you not just whether the company is profitable, but how efficiently it converts each dollar of revenue into profit at different levels of the income statement. But profitability is not just about margins. It is also about returns on the capital deployed in the business. Return on assets, or ROA, is calculated by dividing net income by total assets, and it measures how effectively the company is using its assets to generate profit. A company with a high ROA is generating a lot of profit from a relatively small asset base, which is generally very attractive and suggests that the business does not require massive physical infrastructure to earn its income. Return on equity, or ROE, is calculated by dividing net income by shareholders' equity, and it measures how effectively the company is generating profit from the money that shareholders have invested. ROE is one of the most widely followed measures of profitability for investors because it directly measures the return being generated on the shareholders' investment in the business. Fridson also introduces a very useful tool called the DuPont analysis, which breaks down return on equity into three component parts. Return on equity is equal to net margin multiplied by asset turnover multiplied by financial leverage. Net margin measures profitability, as we discussed. Asset turnover, which is revenue divided by total assets, measures how efficiently the company is using its assets to generate revenue. Financial leverage, which is total assets divided by shareholders' equity, measures how much of the company's assets are financed by debt rather than equity. By breaking return on equity into these three components, you can understand the drivers of a company's returns on equity with much more precision than the single ratio alone provides. Is the company highly profitable on each dollar of sales? Is it using its assets efficiently to generate revenue? Is it amplifying its returns through the use of significant financial leverage? Each of these tells a different story about the nature and sustainability of the company's returns, and each requires a different analytical response. The third category of ratios is activity ratios, which are also called efficiency ratios. These measure how efficiently the company is managing its assets on a day-to-day basis. The most important of these is inventory turnover, which is the cost of goods sold divided by average inventory. This ratio tells you how many times per year the company sells and replaces its entire inventory. A high inventory turnover is generally positive, suggesting that the company is selling products quickly and not accumulating unsold goods that tie up cash. A low inventory turnover might suggest slow sales, obsolete inventory, or poor inventory management, any of which can represent a serious problem if left unaddressed. A related metric is days inventory outstanding, which is calculated by dividing the number of days in a year, 365, by the inventory turnover ratio. This tells you how many days on average a piece of inventory sits in the warehouse before being sold. The lower this number, the more efficiently the company is converting inventory into sales and ultimately into cash. When days inventory outstanding starts climbing quarter after quarter or year after year, it is time to investigate what is causing products to sit on shelves longer than they used to. Similarly, there is accounts receivable turnover, which is revenue divided by average accounts receivable, and its companion metric, days sales outstanding, which is calculated by dividing 365 by accounts receivable turnover. Days sales outstanding tells you how many days on average it takes the company to collect payment from its customers after making a sale. A rising days sales outstanding can be a warning sign that customers are taking longer to pay, which might indicate that the company is extending credit to weaker customers in order to boost sales, or that customers are disputing the quality or value of what they received. On the other side of the ledger, there is accounts payable turnover and days payable outstanding, which measure how long the company takes to pay its own suppliers. A longer days payable outstanding means the company is taking more time to pay its bills. For a powerful company with strong relationships, this can simply reflect favorable payment terms negotiated with suppliers. For a company under financial stress, it can reflect an inability to pay on time, which is a very different and much more concerning situation. The fourth category is leverage ratios, also called solvency ratios or debt ratios. These measure the extent to which a company relies on debt to finance its operations, and they assess the company's ability to meet its long-term debt obligations over time. The most basic leverage ratio is the debt-to-equity ratio, which is total debt divided by total shareholders' equity. This tells you how much debt the company has relative to the equity that shareholders have invested. A higher ratio means more leverage and more financial risk, because debt obligations must be met regardless of how the business is performing. Unlike shareholders, who can accept delayed or reduced returns during difficult periods, lenders insist on being paid on time every time. Another important leverage ratio is the interest coverage ratio, also called the times interest earned ratio. This is calculated by dividing operating income by interest expense. It tells you how many times over the company could pay its current interest expense with its operating income. An interest coverage ratio of 2 means the company's operating income is 2 times its annual interest expense. An interest coverage ratio below 1 means the company cannot cover its interest payments from operating income alone, which is a serious warning sign that default risk is high. Fridson emphasizes the interest coverage ratio repeatedly in his work because it is one of the most direct measures of a company's ability to service its debt without resorting to asset sales or additional borrowing. The fifth category is market-based ratios, which are particularly important for equity investors because they relate the financial statement numbers to the market price of the stock. The most famous of these is the price-to-earnings ratio, which compares the stock price to earnings per share. The price-to-earnings ratio tells you how much investors are willing to pay for each dollar of earnings. A high price-to-earnings ratio means investors expect strong future growth and are willing to pay a premium for that expectation. A low price-to-earnings ratio might indicate a company that is undervalued, or it might indicate a company with poor growth prospects or high risk. The ratio alone does not tell you which interpretation is correct. That is where your deeper analysis comes in. Another important market-based ratio is the price-to-book ratio, which compares the stock price to book value per share. This tells you how much investors are paying relative to the accounting value of the company's net assets. As discussed earlier, companies with strong intangible assets and earning power often trade at high price-to-book ratios because investors are paying for the future earning power that the balance sheet does not capture. Companies with weak earning power or with assets that are overstated on the balance sheet often trade below book value, which should prompt careful investigation rather than automatic excitement about a potential bargain. There is also the enterprise value to EBITDA ratio, which compares the total value of the entire business, including both equity and debt, to its earnings before interest, taxes, depreciation, and amortization. This ratio is particularly useful for comparing companies with different capital structures because it looks at the value of the whole enterprise rather than just the equity slice. When you are comparing two companies in the same industry, one of which has heavy debt and one of which is debt-free, the enterprise value to EBITDA ratio gives you a more apples-to-apples comparison than the price-to-earnings ratio, which would be skewed by the interest expense on the levered company's income statement. Now, let us go deeper into something that separates good analysts from truly great ones, and that is the analysis of earnings quality. Fridson devotes significant attention to this topic because it is so fundamental to investment analysis, and yet so frequently overlooked by investors who are in a hurry to get to a conclusion. As we touched on earlier, earnings quality refers to the degree to which reported earnings accurately reflect the underlying economic performance of the business. High-quality earnings are built on a solid foundation. They are backed by cash generation. They come from the core recurring operations of the business. They are based on conservative accounting choices, and they are sustainable and repeatable in future periods. Low-quality earnings are like a beautiful building constructed on a shaky foundation. They might look impressive from the outside, but they are vulnerable to collapse when conditions change. There are several key indicators of earnings quality that every investor should understand and apply consistently. The first and most powerful is the relationship between earnings and operating cash flow. In a company with high earnings quality, earnings and operating cash flow should move in the same direction and should be fairly close to each other over time. When you see a pattern where earnings are growing, but operating cash flow is not keeping pace, or worse, when earnings are positive, but operating cash flow is negative, that is a major red flag. It means the company is recording profits on paper that are not translating into actual cash in the bank, and that divergence almost always has an explanation that investors should understand before committing capital. This divergence between earnings and cash flow can happen for legitimate reasons in the short term. A rapidly growing company might have high accounts receivable growth as it books sales that have not yet been collected, because it is growing so fast that collection necessarily lags behind the booking of revenue. But if this divergence persists over multiple years without a satisfactory explanation, it suggests something more troubling. It suggests that the company may be using aggressive revenue recognition policies to inflate its reported earnings beyond what the underlying business actually justifies. Revenue recognition is one of the most important and most frequently abused areas of financial accounting. The fundamental principle is that revenue should be recognized when it has been earned, meaning when the company has provided the goods or services and has a legitimate right to payment. But the definition of when revenue has been truly earned involves considerable judgment, and aggressive companies push the boundaries of that judgment as far as the rules allow. Some common revenue recognition abuses include recognizing revenue before a product has actually been delivered to the customer, recognizing revenue on contingent sales where the customer has the right to return the product without restriction, recognizing the full revenue from a long-term contract up front rather than spreading it over the contract period as the work is performed, and creating artificial transactions with related parties to inflate reported sales. Fridson teaches you to watch for all of these patterns by looking carefully at the footnotes describing revenue recognition policies, by comparing revenue growth to cash collection rates, and by tracking changes in accounting policies over time. Related to revenue recognition is the question of expense recognition. Companies have incentives to delay the recognition of expenses, pushing them into future periods and making current period earnings look better than they should. One common technique is to capitalize expenses that should properly be expensed immediately. When a cost is expensed, it reduces earnings in the current period. When it is capitalized, it is treated as an asset on the balance sheet and then slowly expensed over future periods through depreciation or amortization. This might sound technical, but the impact on reported earnings can be enormous. A company that capitalizes routine maintenance costs or that capitalizes marketing expenses by calling them customer acquisition costs and amortizing them over long periods is effectively hiding expenses from its income statement and overstating both current earnings and total assets. Another earnings quality issue involves restructuring charges. Companies frequently announce restructuring programs that involve layoffs, plant closures, and asset write-downs. These restructuring charges are typically treated as one-time items, meaning analysts are supposed to exclude them from their assessment of the company's underlying profitability. But some companies use restructuring charges as a recurring mechanism to clean up their balance sheets and improve future earnings. If a company takes restructuring charges in every single year, calling them one-time items every time, they are not truly one-time items. They are a recurring cost of doing business, and they should be reflected in your assessment of the company's true and sustainable profitability. This brings us to another critical concept that Fridson emphasizes throughout his work, which is the distinction between recurring and non-recurring items in the income statement. Companies often present a version of their earnings that they call adjusted earnings or non-GAAP earnings, which excludes various charges and expenses that the company claims are unusual or non-recurring. These adjustments might include stock-based compensation expense, restructuring charges, amortization of acquired intangibles, and various other items. The companies argue that these adjusted figures give a better picture of the underlying business performance, and sometimes they are right, but sometimes they are using these adjustments to make their financials look significantly better than they truly are. Fridson teaches you to scrutinize these adjustments carefully and critically. Are the excluded items truly non-recurring, or do they repeat year after year with a new label each time? Is the company repeatedly excluding the same types of charges under the guise of calling them non-recurring? Are the adjustments consistent with how competitors in the same industry report their results? Stock-based compensation is a particularly important example of this issue. Companies argue that because it is a non-cash expense, it should be excluded from adjusted earnings. But stock-based compensation is a very real cost to shareholders because it dilutes their ownership when employees exercise their options or vest their restricted shares. Ignoring it gives you an incomplete and flattering picture of the true cost of running the business. Let us now talk about an area that is particularly important for credit investors and bond investors, which is credit analysis. Fridson has a deep background in fixed income and credit markets, and his analysis of credit quality is particularly thorough and insightful, drawing on years of hands-on experience in the high-yield bond market. When you are a bond investor or a lender, your primary concern is different from an equity investor. As an equity investor, you profit when the company grows and generates excess returns above the cost of capital. As a credit investor, your primary goal is simply to get your money back, with interest. You do not benefit from the upside if the company outperforms, but you bear all the downside if the company fails to repay its debt. This asymmetry means that credit investors are laser-focused on risk, and specifically on the risk of default. Fridson provides a comprehensive framework for assessing credit quality. The first and most important question in credit analysis is whether the company can service its debt, meaning whether it can make its interest payments reliably and eventually repay the principal when it comes due. The interest coverage ratio, which we discussed earlier, is one of the key tools for answering this question. But Fridson goes further and looks at a range of metrics together to form a complete picture of credit strength, rather than relying on any single number. The level of total debt relative to EBITDA is a very commonly used measure of leverage in credit analysis. A company with total debt equal to 2 times its annual EBITDA is considered conservatively leveraged in most industries. A company with total debt equal to 6 times EBITDA is considered highly leveraged and is at significant risk if economic conditions deteriorate or if business performance disappoints even modestly. Companies with very high leverage ratios are often called highly leveraged companies, and the bonds they issue are called high-yield bonds, or, in colloquial financial language, junk bonds. Fridson spent much of his career analyzing high-yield bonds, and his insights into credit analysis are particularly deep and practical in this area. The debt maturity profile of a company is another critical element of credit analysis. Even a company with a manageable overall debt level can face a sudden liquidity crisis if a large amount of that debt comes due at the same time, and the company cannot roll it over into new borrowing or repay it from cash flow. The period leading up to a large debt maturity, sometimes called a maturity wall, can be a very dangerous time for a company. Investors should always look at the footnotes to the balance sheet to understand when the company's debt matures and how much is coming due in each future year, so they can assess whether the company will face a refinancing challenge. Another important concept in credit analysis is the concept of collateral and capital structure. When companies borrow money, they sometimes pledge specific assets as collateral, meaning if they cannot repay the loan, the lender has a claim on those specific assets. Secured debt, which is backed by collateral, is less risky than unsecured debt, which has no specific assets pledged behind it. Within the capital structure, secured debt is senior to unsecured debt, which is senior to subordinated debt, which is senior to preferred equity, which is senior to common equity. This hierarchy of claims is sometimes called the capital structure, and understanding where different securities sit in that hierarchy is fundamental to understanding the risk and potential return of each one. Fridson also introduces the concept of covenant analysis. Most debt agreements include covenants, which are promises that the borrower makes to the lender about how it will conduct its business while the debt is outstanding. Financial covenants typically include things like a minimum interest coverage ratio, a maximum leverage ratio, and a minimum level of shareholders' equity. If the company violates these covenants, it is considered to be in technical default, even if it has not actually missed a payment. A covenant violation gives the lender the right to demand immediate repayment, which can force a company into bankruptcy even when it still has positive cash flow. Investors should always review the debt covenants disclosed in the footnotes and assess how much cushion the company has relative to its covenant limits, because a company operating close to its covenant limits is a company walking a financial tightrope. Now let us talk about equity analysis, which is the other major application of financial statement analysis. Equity analysis involves assessing the value of a company's stock and determining whether it represents a good investment at its current market price. The foundation of equity valuation is the idea that the value of any investment is the present value of all the future cash flows it will generate for its owner. For stocks, this means that the fair value of a share is the present value of all the dividends and residual cash flows that it will generate for shareholders over the entire life of the company. The challenge, of course, is that no one knows with certainty what those future cash flows will be, or what the appropriate rate at which to discount them is. This uncertainty is at the heart of why stock prices fluctuate and why different investors can look at the same company and reach very different conclusions about whether it is cheap or expensive. One of the most widely used approaches to equity valuation is the discounted cash flow model, or DCF model. In a DCF model, you forecast the company's free cash flows for a number of years into the future, and then you estimate a terminal value to capture the value of all the cash flows beyond the explicit forecast period. You then discount all of these cash flows back to the present using a discount rate that reflects the riskiness of the investment. The resulting number is your estimate of the intrinsic value of the stock, and comparing it to the current market price tells you whether the stock appears cheap, fairly valued, or expensive. The DCF model is powerful because it forces you to think explicitly about the drivers of the business, including revenue growth rates, margin trajectories, capital expenditure requirements, and working capital dynamics. It also forces you to be precise about the discount rate, which encapsulates the risk of the investment. However, the DCF model is also sensitive to small changes in assumptions. A small change in the assumed long-term growth rate or in the discount rate can have a very large impact on the resulting valuation, which means that DCF valuations should be used as a guide to a range of possible values rather than as a precise point estimate of exactly what the stock is worth. Another common approach to equity valuation is comparable company analysis, which involves comparing the target company's valuation multiples to those of similar companies in the same industry. If comparable companies are trading at an enterprise value to EBITDA multiple of 8 times, and your target company is trading at a multiple of 5 times on a similar quality business, it might suggest that the target company is undervalued relative to its peers. Conversely, if the target is trading at 12 times while its peers are at 8 times, it might be overvalued unless there is a compelling reason, such as superior growth prospects or a structural competitive advantage, to justify the premium. Fridson also discusses the Gordon growth model, which is sometimes called the dividend discount model. This model values a stock as the next expected dividend divided by the required rate of return, with the expected long-term growth rate of dividends taken away from the denominator. This model is particularly useful for valuing mature, stable companies that pay consistent and growing dividends, such as utility companies, consumer staples companies, and real estate investment trusts. These types of companies have predictable cash flows and dividend policies that lend themselves well to this kind of dividend-based valuation framework. Now, let us turn to one of the most important topics in the entire book, which is how to identify red flags in financial statements. Red flags are warning signs that suggest something may be wrong with a company's financial condition or the integrity of its financial reporting. Catching red flags early can save you from catastrophic and permanent losses of capital, which every serious investor must prioritize avoiding. Fridson identifies numerous red flags across all 3 financial statements. Let us work through the most important ones systematically. The first red flag is a persistent and growing gap between net income and operating cash flow. As we discussed, in a healthy business, earnings and cash flow should be broadly aligned over time. When earnings consistently outpace cash flow by a large and growing margin, something is wrong. The company may be using aggressive accounting to inflate earnings, or it may have a business model problem where it books revenue that it cannot actually collect in cash. The second red flag is rapid growth in accounts receivable relative to revenue. If a company's revenue grew by 10% in a year, but accounts receivable grew by 30%, it means the company is selling more, but collecting cash at a much slower rate. This could mean it is extending credit to weaker customers to boost reported sales figures, or it could indicate that customers are disputing invoices, returning goods, or simply unable to pay. The third red flag is rapid growth in inventory relative to cost of goods sold. If a company's cost of goods sold grew by 10% in a year, but inventory grew by 40%, it may mean the company is having serious trouble selling its products, that it overproduced in anticipation of demand that did not materialize, or that some of the inventory has become obsolete and is no longer saleable at full price. In manufacturing and retail businesses, obsolete inventory that is eventually written down destroys profits suddenly and without warning. The fourth red flag is a dramatic increase in days sales outstanding over time. When this number is increasing significantly over multiple periods, it is a warning that either the quality of the receivables is deteriorating, meaning customers are not paying on time, or that the company is using aggressive revenue recognition policies to book sales that have not truly been earned in the economic sense. The fifth red flag is recurring restructuring charges. If a company takes restructuring charges in most years, calling them non-recurring each time, it is a sign that the business is chronically struggling and that the true ongoing cost structure is higher than the adjusted earnings figures suggest. One occurrence of a restructuring charge deserves scrutiny. A pattern of annual restructuring charges demands deep investigation. The sixth red flag is frequent changes in accounting policies, particularly changes that happen to improve reported results. When a company changes its accounting methods, it should provide a clear explanation and show the quantitative impact of the change on the financial statements. If a company frequently changes its methods in ways that result in higher revenues or lower expenses, it is worth investigating carefully. Legitimate businesses with stable operations do not need to keep changing their accounting policies. The seventh red flag is significant related party transactions. When a company engages in significant transactions with entities that are related to its major shareholders, its executives, or its board members, there is always a risk that these transactions are not conducted on arm's-length market terms. There is a risk that the related party is either overpaying for something from the company, inflating reported revenue, or selling something to the company at an inflated price, benefiting insiders at the expense of outside shareholders who are unaware of the arrangement. The eighth red flag is sudden auditor changes. When a company changes its auditor, particularly if the change comes abruptly or if the company has a history of switching auditors, it is worth investigating the reason. In some cases, the previous auditor was concerned about a specific accounting treatment and the company switched to a more accommodating firm. This is sometimes called opinion shopping, and it is a significant warning sign that the company's management may be prioritizing the appearance of good results over accurate reporting. The ninth red flag is a complex corporate structure with many subsidiaries and special purpose entities. Complex corporate structures can be legitimate for business or tax reasons, but they can also be used to hide debt, move poor-performing assets off the balance sheet, or conduct transactions that obscure the true financial picture. The collapse of Enron, one of the most famous and destructive corporate frauds in financial history, involved extensive use of special-purpose entities to hide billions of dollars of debt from investors and analysts who were looking only at the consolidated financial statements. The 10th red flag is aggressive goodwill accounting. When companies make acquisitions and record large amounts of goodwill, they are required to test that goodwill for impairment at least annually. If the acquired business is not performing as expected, the goodwill should be written down, which reduces reported earnings and acknowledges that the acquisition was overpriced. However, companies are sometimes extremely reluctant to take goodwill impairments because they signal publicly that past acquisitions were mistakes and that management destroyed value through those deals. If a company has a large goodwill balance that has remained suspiciously stable for many years, despite acquired businesses clearly underperforming, it is worth questioning whether the goodwill is properly stated on the balance sheet. Let us now talk about something that sits at the intersection of accounting and economics, which is the concept of economic value added. The basic idea is powerful in its simplicity. A company only truly creates value for its shareholders when it earns a return on its invested capital that exceeds its cost of capital. This seems obvious when stated plainly, but many investors lose sight of it in practice. The cost of capital is the weighted average of the cost of equity and the cost of debt, reflecting the overall cost of the money the company uses to fund its operations. If a company earns a return on invested capital of 15% and its cost of capital is 10%, it is creating economic value at a rate of 5% per year on its invested capital base. If it earns a return of 8% and its cost of capital is 10%, it is actually destroying economic value, even if it is reporting positive accounting profits. This distinction between accounting profit and economic profit is fundamental to sophisticated financial analysis and to understanding which businesses are truly excellent and which are merely adequate on the surface. Fridson teaches investors to look at return on invested capital in relation to cost of capital as one of the most powerful tools for evaluating the long-term value creation potential of a business. Companies that consistently earn returns well above their cost of capital are compounding value for shareholders at an impressive rate. Companies that earn returns below their cost of capital are destroying value over time, even if their stock price has not yet reflected this uncomfortable reality. Now, let us discuss the role of management quality and corporate governance in financial statement analysis, because numbers do not exist in a vacuum. They are produced by people, and the quality of those people, their judgment, their integrity, and their incentives matters enormously to the reliability and sustainability of the reported results. One of the things Fridson emphasizes is the importance of going through the management discussion and analysis section, which is often called the MD&A. This is a section of a company's annual report in which management is required to discuss the company's financial results, the factors that drove those results, and the key risks and uncertainties facing the business going forward. A well-written MD&A that addresses both the positives and the negatives of the year, honestly and directly, is a positive sign of management quality and transparency. An MD&A that is full of vague language, that focuses exclusively on the positives while glossing over obvious problems, that uses jargon to obscure rather than clarify, or that fails to address risks that are clearly visible from the financial statements themselves, is a red flag about management's candor and honesty with shareholders. Executive compensation is another important area of analysis. How are the top executives being paid? Are their incentives aligned with the long-term interests of shareholders? Or are their bonuses tied to short-term metrics like earnings per share, which could encourage short-sighted decisions that boost near-term numbers at the expense of long-term value? Stock option grants, in particular, can create perverse incentives if executives have the ability to profit enormously by boosting the stock price in the short term through earnings management or financial engineering rather than genuine business improvement. Understanding the compensation structure helps you understand the incentives that actually drive management decisions day to day. Corporate governance, more broadly, is also worth examining carefully. Is the board of directors truly independent from management, or is it filled with the chief executive's friends and associates who will not ask hard questions? Are the audit committee members truly knowledgeable about accounting and finance? Is there a dominant founder or controlling shareholder who can make unilateral decisions without accountability to other shareholders? These governance factors do not show up directly in the financial statements, but they significantly influence the quality and reliability of those statements over time. Now let us talk about industry-specific analysis, because financial analysis is not a one-size-fits-all exercise. Different industries have different economics, different cost structures, different working capital dynamics, and different ways of measuring performance. What constitutes a good or bad ratio depends heavily on the industry context, and applying the same standards across vastly different industries will lead you to wrong conclusions. For example, in the banking industry, the concept of leverage takes on a completely different meaning than in manufacturing. Banks are inherently highly leveraged businesses, and their leverage ratios should be evaluated against other banks, not against the general corporate sector. Banks are better analyzed using metrics like net interest margin, which measures the spread between the interest they earn on loans and the interest they pay on deposits, and return on equity, which for banks reflects both the profitability and the leverage of the institution. The quality of a bank's loan portfolio, measured by metrics like the ratio of non-performing loans to total loans and the level of loan loss reserves, is of paramount importance and has no real analog in industrial company analysis. In the retail industry, same-store sales growth is one of the most critical metrics, and it is a concept that has no direct equivalent in most other sectors. Same-store sales measure the revenue growth of stores that have been open for at least a year, stripping out the effect of new store openings. A retailer that is growing total revenue but seeing declining same-store sales is essentially covering up weak existing store performance by opening new locations. This is not a sustainable strategy because each new store requires capital investment, and if the underlying sales productivity is declining at existing locations, eventually, the new openings cannot offset the weakness and total performance deteriorates. In the technology industry, particularly for software companies, the subscription and recurring revenue model has become dominant over the past 2 decades. For these companies, key metrics include annual recurring revenue, net revenue retention, which measures how much revenue is retained and expanded from existing customers versus the prior year, customer acquisition cost, and customer lifetime value. These metrics may not appear directly in the financial statements, but are often disclosed in the management discussion and analysis section or in supplemental disclosures. Understanding these metrics is essential for evaluating the quality, durability, and growth trajectory of a software company's revenue stream. In the energy industry, production volumes, reserve levels, and finding and development costs are critical metrics. The financial statements of an oil and gas company alone are not sufficient to evaluate the company without understanding the underlying asset base of proven oil and gas reserves, because it is those reserves that drive all future production and cash flow. The Reserve Life Index, which is the number of years of production the current reserves represent, is a fundamental indicator of the long-term sustainability of an energy company's business. In the healthcare industry, understanding the payer mix, which refers to the proportion of revenue coming from government programs versus private insurance versus out-of-pocket payments, is critical because government programs typically reimburse at lower rates than private insurance. The pipeline of new products for pharmaceutical companies and the regulatory risks associated with obtaining approval for those products can represent a much larger portion of a company's fair value than anything visible on the current balance sheet or income statement. The point that Fridson makes, and that is broadly applicable across all industries, is that financial ratio analysis and financial statement analysis must always be conducted in the context of a deep understanding of the industry, its competitive dynamics, its regulatory environment, and its underlying economic drivers. Numbers without context are meaningless. Numbers in their proper context are enormously powerful. Let us now turn to an area that is particularly relevant in today's market environment, which is the analysis of companies that are growing rapidly and have not yet reached profitability. Many of today's most discussed companies in sectors like technology, biotechnology, electric vehicles, and clean energy are companies that are burning through cash while they invest heavily in building their businesses for the future. Traditional profitability metrics, like the price-to-earnings ratio and net profit margin, are not applicable to these companies, at least not in their current stage. How do you analyze a company that has no earnings to speak of? Fridson addresses this challenge by focusing on the quality and sustainability of the company's cash burn, the trajectory toward eventual profitability, the size and dynamics of the market opportunity, and the company's competitive positioning relative to others pursuing the same opportunity. Key metrics for pre-profitability companies include the cash runway, which is how long the company can continue operating at its current cash burn rate before it runs out of money and needs to raise additional capital. A company with 2 years of cash runway is in a very different position from one with only 6 months. The growth rate of revenue is critical because for these companies, the entire investment thesis is almost exclusively about future growth and the potential for large future profits. The unit economics of the business, meaning whether the company can make money on each individual transaction or customer at current scale, is another key indicator of whether the business model is fundamentally sound and worth investing in. Now let us revisit and reinforce some of the most critical specific skills that Fridson teaches, because these are the practical tools you will reach for again and again in your investing journey. The first skill is detecting earnings manipulation. Companies manipulate earnings for many reasons, including to meet analyst expectations, to maximize executive bonuses tied to earnings targets, to support a high stock price before an equity offering, or to hide deteriorating business fundamentals from investors and analysts. The most reliable way to detect earnings manipulation is to compare earnings to cash flow consistently over time. Legitimate businesses have earnings and cash flow that track each other reasonably well over multi-year periods. Manipulated earnings consistently diverge from cash flow in a direction that flatters reported profits. The second skill is adjusting reported earnings for non-recurring items. This requires judgment, but the guiding principle is clear. Truly non-recurring items are unexpected and genuinely unlikely to repeat. A charge that appears in 4 out of the last 5 years is not non-recurring, regardless of what management calls it. When you normalize earnings for these recurring charges, you often get a very different and more realistic picture of what the company actually earns in a typical year. The third skill is analyzing the quality of the balance sheet rigorously. This means asking whether the assets on the balance sheet are really worth what they say they are worth. Is inventory properly valued at current market prices or at outdated cost? Are receivables actually collectible, or do they include amounts from customers who are unlikely to pay? Is goodwill supported by the actual performance of the acquired businesses, or has it been impaired in economic reality but not yet written down on the books? The fourth skill is building a mental and analytical bridge between the income statement and the cash flow statement. This means understanding precisely why operating cash flow differs from net income and whether those differences represent normal business dynamics or concerning patterns that deserve further investigation. The fifth skill is going through the footnotes to the financial statements systematically, because that is where the most important details are always found. Revenue recognition policies, debt maturity schedules, lease obligations, pension assumptions, contingent liabilities, related party transactions, and the details of significant accounting estimates and judgments all live in the footnotes, away from the headline numbers that most investors focus on. The sixth skill is using financial ratios in comparison, not in isolation. A single ratio number means very little on its own. A ratio compared to peers, compared to the company's own historical trend, and compared to industry benchmarks means a great deal. Context is not optional in financial analysis, it is essential. The seventh skill is understanding the business model well enough to evaluate the financial statements with appropriate context. This means understanding how the company makes money, what drives its costs, how it competes with rivals, what its pricing power looks like, and what the key risks to its business model are. Without this business understanding, financial analysis is just number manipulation without meaning. Now, let us discuss some real-world applications of financial statement analysis, because the best way to solidify these concepts is to see how they play out in practical situations. Consider a hypothetical consumer products company that has been reporting steadily growing earnings per share for 5 consecutive years. Revenue has grown at an average rate of 8% per year. Earnings per share have grown at an average rate of 15% per year. On the surface, this looks like a tremendously successful and well-managed business. But when you dig into the financial statements carefully, you discover several things that should give you pause. First, while earnings per share are growing at 15% per year, operating cash flow is only growing at 5% per year. The gap between earnings and cash flow has been widening every single year. Second, accounts receivable have been growing at twice the rate of revenue, suggesting that the company is extending more credit and collecting more slowly, which may mean it is reaching weaker and weaker customers to sustain reported sales growth. Third, the days inventory outstanding has been increasing, suggesting that the company is having more difficulty selling its products at full price. Fourth, the gross margin has been declining slightly each year as the company faces intensifying competition and has had to offer discounts to maintain volume. Fifth, the company has been making share repurchases financed by new debt, which mechanically increases earnings per share, even as the underlying business is gradually weakening. Taken together, these observations tell a very different story than the headline earnings per share growth number. The underlying business is actually losing competitive ground, cash generation is deteriorating, and the balance sheet is getting more leveraged, even as management reports success to shareholders. The earnings per share growth is a result of financial engineering, specifically debt-financed buybacks and favorable accounting, rather than genuine business improvement. This is exactly the kind of situation where financial statement analysis reveals a danger that is completely invisible to someone who only looks at the headline numbers and buys into the story of success. Now consider another example, this time a positive one. Imagine a small industrial company that is trading at what appears to be a very low valuation relative to its reported earnings. The price-to-earnings ratio is 7, well below the market average of 20, suggesting the company might be very cheap. Most investors pass it by, assuming there must be something fundamentally wrong that explains the low valuation. But when you analyze the financial statements carefully, you discover something surprising. The low price-to-earnings ratio is partly a reflection of the company's conservative accounting practices. The company expenses research and development costs immediately, rather than capitalizing them, which reduces reported earnings below what a more aggressive accounting policy would show. It uses conservative depreciation schedules, which reduce earnings further. And it has a large pension fund that is significantly overfunded, meaning the pension assets are worth substantially more than the pension obligation, creating a large hidden asset that is not visible in the stock price. When you adjust for these factors, the true earning power of the business is significantly higher than reported earnings suggest. The company also generates very strong free cash flow relative to its market capitalization. And it has a rock-solid balance sheet with no debt and a large cash balance. The apparent cheapness turns out to be genuine cheapness, and the low price represents an attractive opportunity that most investors have overlooked because they did not take the time to go beyond the headline numbers and investigate what is really going on. These kinds of situations, where careful financial statement analysis reveals realities that are invisible to casual observers, are the foundation of superior long-term investment returns. And this is ultimately what Fridson's work is about at its deepest level. It is about giving you the tools and the intellectual discipline to see what others cannot see, to understand what others do not understand, and to make decisions based on economic reality rather than accounting appearances. Let us now discuss some of the more advanced topics that Fridson covers, which are particularly relevant for sophisticated investors who want to take their analysis to the next level. One of the most technically complex areas of financial analysis is the accounting for pensions and other post-retirement benefits. Companies that promise retirement income and healthcare benefits to their employees face a genuinely difficult accounting challenge. The obligation to pay these future benefits must be estimated today, using assumptions about things like how long employees will live, how rapidly healthcare costs will rise, and what investment return the pension fund will earn over decades. Small changes in these assumptions can result in very large changes in the reported pension obligation, which flows through to the balance sheet and affects the income statement through pension expense. Understanding these mechanics is important for any investor looking at a company with a large defined benefit pension plan. Fridson explains the difference between the defined benefit pension plan, where the employer promises a specific level of retirement income regardless of investment performance, and the defined contribution plan, where the employer simply makes contributions to each employee's retirement account without promising a specific outcome. Defined benefit plans create ongoing and potentially very large obligations for the employer that must be estimated, monitored, and reflected in the financial statements. Defined contribution plans shift the investment risk entirely to the employee and create no ongoing balance sheet obligation for the employer beyond making the current year's contributions. For companies with large defined benefit pension plans, the funded status of the plan is a critical number to examine. This is the difference between the value of the plan assets and the present value of the projected benefit obligation. If the plan assets are greater than the obligation, the plan is overfunded, which represents a form of hidden wealth that does not show up prominently in the stock price. If the plan assets are less than the obligation, the plan is underfunded, which represents a form of hidden debt that the market may not be fully pricing into the company's valuation. Large changes in the funded status can significantly affect shareholders' equity through other comprehensive income, a component of the equity section of the balance sheet that is separate from the income statement. This means that large pension losses can substantially reduce reported shareholders' equity without any effect on reported net income, which is another powerful reason why looking only at the income statement gives you a dangerously incomplete picture. Another advanced topic is the accounting for derivatives and hedging. Companies use financial derivatives like forward contracts, options, and interest rate swaps to manage various financial risks that arise from their business operations. A company that sells products denominated in foreign currencies might use forward contracts to lock in exchange rates and protect against unfavorable currency movements. A company with floating rate debt might use interest rate swaps to convert that debt to a fixed rate, providing certainty about future interest costs. The accounting for these instruments can be complex, and the footnotes about derivative positions are important for understanding the true financial risk profile of the business, including risks that may not be obvious from the income statement or balance sheet alone. Fridson also discusses the accounting for business combinations in considerable depth, because mergers and acquisitions are enormously common in the corporate world, and their accounting creates complexities that affect reported earnings for years after the deal is completed. When a company acquires another business, the acquisition must be accounted for using the acquisition method, which requires the acquirer to recognize the acquired company's assets and liabilities at their fair values at the date of acquisition. Any excess of the purchase price over the fair value of net assets is recorded as goodwill. The subsequent accounting for these fair value adjustments and for goodwill is important to understand, because amortization of intangible assets identified in a business combination can significantly reduce reported earnings for many years after the acquisition, even if the underlying business is performing exactly as planned. Related to this is the concept of purchase price allocation, which is the process of assigning the total acquisition price to the individual assets and liabilities of the acquired company. The way the purchase price is allocated can significantly affect future reported earnings in either direction. If more of the price is allocated to long-lived assets with low amortization rates, future earnings will be higher. If more is allocated to short-lived intangibles with high amortization rates, future earnings will be lower. Understanding how an acquisition's purchase price has been allocated, which is always disclosed in the footnotes, is important for accurately forecasting the earnings that will result from the acquired business in future periods. Let us now turn to an important topic in the analysis of multinational corporations, which is the impact of foreign currency translation on financial statements. When a company operates in multiple countries and in multiple currencies, it must translate the financial results of its foreign operations into its single reporting currency. This translation process can significantly affect reported revenues, earnings, and balance sheet values in ways that have nothing to do with the actual performance of the underlying businesses. If the reporting currency strengthens against foreign currencies during a period, the translated value of foreign revenues and earnings will decline in reporting currency terms, even if the underlying businesses are performing well in their local currencies. Conversely, if the reporting currency weakens, foreign revenues and earnings will appear to grow when expressed in the reporting currency, even without any improvement in the underlying business at the local level. Companies typically disclose the impact of currency effects on their results in the management discussion and analysis section, allowing investors to understand the constant currency or local currency performance of the business separate from the translation effect. The balance sheet is also affected by currency translation. Assets and liabilities of foreign subsidiaries are translated at the exchange rate in effect at the balance sheet date, while shareholders' equity is translated at historical rates. The resulting difference is captured in accumulated other comprehensive income, which can cause significant fluctuations in reported book value without any change in the underlying operations. For companies with large international operations, this translation adjustment can be a very significant line item in the equity section of the balance sheet. Now let us revisit and expand on the topic of working capital analysis, because it is one of the most practically important areas of financial statement analysis for understanding the short-term health of a business and detecting early signs of deterioration. Working capital is defined as current assets with current liabilities taken away. Positive working capital means the company has more short-term assets than short-term liabilities, giving it liquidity to meet near-term obligations. Negative working capital means the opposite, which can be a sign of stress or, in certain business models, like subscription businesses that collect cash up front before delivering the service, a normal and even advantageous feature of the business model. Context, as always, determines whether negative working capital is a strength or a warning. The changes in working capital from one period to the next are what appear in the operating activities section of the cash flow statement. An increase in accounts receivable consumes cash. An increase in inventory consumes cash. An increase in accounts payable provides cash. An increase in accrued expenses provides cash. By analyzing these changes carefully and in relation to revenue and cost growth, you can understand the dynamics of the business and detect potential problems well before they become obvious to the broader market. One particularly important pattern to watch for is when a company's working capital builds up rapidly relative to its revenue. Growing accounts receivable faster than revenue could mean the company is making more sales, but collecting more slowly. Growing inventory faster than cost of goods sold could mean that sales are slowing or that production is outpacing demand. Both of these patterns consume cash and can be early warning signs of business deterioration that will eventually force the company to take write-downs or slow its growth. The cash conversion cycle is a metric that combines days sales outstanding, days inventory outstanding, and days payable outstanding into a single comprehensive measure of how long it takes a company to convert its investments in inventory and other resources into cash flows from sales. A shorter cash conversion cycle means the company needs less cash to fund its working capital, which is a significant competitive advantage. A company with a very short or even negative cash conversion cycle, which happens when it collects from customers before it has to pay suppliers, is in an enviable position that allows it to grow without needing to raise additional capital to fund working capital expansion. Let us now discuss the analysis of financial institutions, particularly banks, because these businesses have unique financial characteristics that require specialized approaches quite different from those used for industrial or technology companies. Banks are fundamentally different from industrial companies in one key respect. Their primary business is taking in money from depositors at a low cost and lending it out at a higher cost, earning the spread between the two. This makes them inherently highly leveraged institutions, with assets typically many times larger than their equity capital. For a non-financial company, a debt-to-equity ratio of 3 or 4 would be considered dangerously high. For a bank, Having assets that are 10 to 20 times equity is entirely normal and expected by regulators, rating agencies, and investors alike. This means that the standard leverage ratios used for industrial companies are simply not appropriate for banks. Instead, banks are evaluated using capital ratios, which measure the adequacy of their equity capital relative to their risk-weighted assets. Regulatory capital requirements established under the International Basel Framework set minimum capital ratios that banks must maintain to be considered adequately capitalized. Banks that fall below these minimums face regulatory intervention, restrictions on dividend payments, and potential forced recapitalization. The quality of a bank's loan portfolio is the single most important driver of its financial health, because lending is the core of the business. Banks earn revenue from the interest on their loans, but they also face the constant risk that borrowers will default and be unable to repay what they owe. When loans go bad, banks must recognize loan loss provisions, which are charges against income that reduce reported earnings and reduce the carrying value of the loan portfolio on the balance sheet. During periods of significant economic stress, loan losses can be enormous and can rapidly destroy a bank's capital, as witnessed during the global financial crisis of 2008 and in previous cycles. Key metrics for analyzing a bank's loan portfolio quality include the non-performing loan ratio, which measures the proportion of total loans that are not paying interest on time; the net charge-off ratio, which measures the loans that have actually been written off as uncollectible in the period, after recovering what can be recovered from previously charged-off loans; and the loan loss reserve ratio, which measures the amount set aside in reserve to cover future expected loan losses as a proportion of total loans. The level of loan loss reserves relative to non-performing loans is a particularly important metric that tells you whether the bank has been proactive or reactive in recognizing the problems in its portfolio. Now, one more important area that Fridson addresses is the analysis of companies in financial distress. When a company is struggling financially, the analytical framework changes in important ways. In a healthy company, the going concern assumption, which is the assumption that the company will continue to operate indefinitely, is taken for granted. But in a distressed company, the going concern assumption is in question. The auditor may include a going concern qualification in the audit opinion, which is one of the most significant warning signals in all of financial reporting. When analyzing a distressed company, the focus shifts from profitability metrics to immediate liquidity and survival metrics. The most urgent question is whether the company can survive in the short term. How much cash does it have? How much is it burning each month? How long until it runs out of cash at the current burn rate? Can it access additional credit facilities or raise equity capital to survive? These survival questions take absolute precedence over longer-term profitability questions. If a company is in or approaching bankruptcy, the analysis shifts further to recovery analysis. In bankruptcy, different creditors have different priority claims on the company's assets. Secured creditors are paid first from the proceeds of the specific assets pledged as collateral for their loans. Then, general unsecured creditors are paid. Then, subordinated creditors. Then, preferred shareholders. And finally, if anything remains after all creditor claims are satisfied, common shareholders receive what is left. In most bankruptcy cases, common shareholders receive nothing at all because the company's assets are not sufficient to satisfy even all the creditor claims, let alone the equity holders who stand last in line. Understanding the capital structure and the hierarchy of claims in a distressed situation is essential for evaluating where recoverable value might exist. Now, as we approach the conclusion of this comprehensive journey through financial statement analysis, let us step back and think about the broader implications of everything we have covered together. The most important insight in all of Fridson's work is this: financial statements are the language of business. If you want to truly understand a business, if you want to evaluate whether it represents a good investment opportunity, If you want to assess whether it is financially healthy or quietly deteriorating, you must be able to speak this language fluently. You must be able to examine the numbers, understand what they mean, detect when they are misleading or manipulated, and use them to form a clear and accurate picture of the underlying economic reality behind the reported figures. But examining financial statements is not an end in itself. It is a means to an end, and that end is making better investment decisions. Better decisions mean higher returns over time, fewer costly mistakes, lower permanent losses of capital, and ultimately, the building of lasting wealth. And this is what makes financial statement analysis one of the most practically valuable skills that any investor can develop and refine throughout their career. The investors who consistently outperform over long periods share a deep ability to analyze financial statements and to understand business economics at a level that most market participants simply do not. This is not a coincidence. The ability to see what others cannot see, to understand what the numbers really mean beneath the surface, to detect danger before it becomes obvious to the market, and identify opportunity before the crowd arrives. This is what separates genuinely excellent investors from average ones. And this edge is available to anyone willing to develop it through consistent study and application. Here is the most encouraging reality about all of this. These skills are learnable. They require study, practice, and patience. They require a commitment to going deeper than the headlines, to questioning the numbers, to going through the footnotes, and to thinking carefully about the economics of the businesses you are evaluating. But they are not mystical gifts, available only to a fortunate few. They are systematic, teachable, learnable skills that any serious and determined investor can develop over time with the right framework and the right habits. Fridson's work provides the roadmap. The journey requires your commitment to applying these principles consistently across many companies and many market cycles, with intellectual honesty and the discipline to act on what your analysis reveals rather than on what you hope is true. Every successful long-term investor has walked this path, and with the knowledge you have gained today, you are better equipped than ever to walk it with confidence. Let us do a final review of the most important principles and tools we have covered so that they remain firmly in your mind as you go forward and apply them to real investment decisions. The three financial statements, the income statement, the balance sheet, and the cash flow statement, each tell a different part of the story of a business, and they must always be examined together to get the complete and accurate picture. Net income, the bottom line of the income statement, is often the most manipulated number and should always be compared against operating cash flow to assess the true quality of reported earnings. The balance sheet provides a snapshot of a company's financial position, but it must be adjusted for the fact that many assets are recorded at historical cost rather than current market value, and many valuable intangible assets are not reflected at their true economic worth. The cash flow statement, particularly free cash flow, is one of the most important measures of a company's true financial performance and the most reliable foundation for most serious valuation approaches. Financial ratios are powerful tools, but must always be used in comparison, not in isolation. Compare to peers in the same industry, compare to the company's own history over multiple years, and compare to relevant industry benchmarks. Earnings quality is perhaps the single most important concept in financial analysis. High-quality earnings are backed by cash, come from recurring operations, and are based on conservative accounting choices. Low-quality earnings are fragile, often temporary, and frequently high deteriorating underlying performance. The footnotes to the financial statements are where the most important details are disclosed by law. Investors who do not go through the footnotes are making decisions with dangerously incomplete information. Red flags, like diverging earnings and cash flow, rapidly growing receivables or inventory, recurring charges labeled as non-recurring, frequent accounting policy changes, and significant related party transactions all demand careful and thorough investigation before any capital is committed. Context is everything. Ratios and metrics must be interpreted in the context of the specific industry, the broader economic environment, and the company's own history. Without context, numbers are just numbers. Financial analysis is a skill that combines technical knowledge with judgment, and developing truly great judgment requires consistent practice applied across many different companies and market conditions over time. These principles, applied diligently and consistently, are the foundation of superior financial analysis and superior long-term investment performance. They are the tools that the world's most successful professional investors use every day to separate the truly excellent businesses from the mediocre ones, and the genuinely attractive investments from those that only appear attractive on the surface. They are the tools that Martin S. Fridson has spent his career developing, refining, and teaching to serious investors and analysts, and they are now yours to apply with the same discipline and rigor. Every quarter, when companies release their earnings reports and financial statements, most investors will look at the headline numbers, react emotionally to whether results beat or missed analyst expectations, and make hasty decisions based on incomplete and often misleading information. You now have the knowledge to do something very different. You can look beneath the headlines with the skill and confidence of someone who genuinely understands what the numbers mean. You can assess the quality of the earnings, check the balance sheet strength, evaluate the cash generation, study the footnotes, ask the questions that most investors do not even know to ask, and make decisions based on the true financial reality of the businesses you are evaluating rather than on their surface appearance. That is a significant and genuine edge in a world where most participants are operating on incomplete information and emotional impulses. Use it wisely, apply it consistently, refine it continuously as you gain more experience and exposure to different businesses and industries. And remember that the greatest investment in knowledge always pays the richest dividends over time. The numbers tell the truth about every business. The truth is always in there, waiting to be found by someone with the skills and the patience to look for it carefully. And now, you have both.